When you build wealth entirely within the borders of where you live, every asset you own shares the exact same geographic risk. Investors naturally default to a 100% domestic portfolio. You know the local market, you consume the local news, and you see the physical infrastructure around you. It feels inherently safe. But holding all your wealth in one country exposes you to a quiet mathematical headwind, inflation-driven currency depreciation. Historically, because inflation and interest rates in developing markets run higher than in developed nations, the local currency steadily loses ground. This chart plots the upward growth of local domestic assets against a steadily declining currency devaluation line. Even when your domestic portfolio hits double-digit returns on paper, the widening gap between these two lines represents a severe loss in your actual global purchasing power. You know you need an international hedge. But the moment you try to diversify, you hit a wall of mechanical friction. You have to navigate feeder funds, foreign brokers, and remittance limits, which leads most people to simply take the path of least resistance and dump their money into familiar U.S. tech names. To allocate effectively, we have to match the geographical markets that actually make sense right now with the mechanical investment route that fits your specific capital level and tax tolerance. Allocating capital globally is not a strategy for scoring quick returns on the latest AI hardware stock. It is a mandatory structural hedge to ensure your portfolio survives long-term currency erosion and localized economic shocks. The default assumption for almost anyone stepping outside their home country is to buy U.S. large-cap tech. It's the largest economy, and the companies are household names. Cautionary. This split-screen chart illustrates the structural trade-off of that strategy. On the left, we track a U.S. tech index. You are buying in at peak historical valuations, exposing your capital to a sector where sudden drawdowns of 60 to 70% happen in extremely short periods of time. Look at the right side of the visualization. This plots an allocation to emerging markets, like China or South Korea, or broad world funds. These regions have spent years generating near-zero returns, which means they are currently sitting at highly attractive, stable valuations. Emerging markets lack the cocktail party appeal of owning the Magnificent Seven. They require patience while market cycles turn, but they provide the mathematical downside protection you need when global markets correct. Chasing familiar U.S. blue chips, specifically because they feel safe, exposes you to massive valuation risks. Real downside protection requires true geographical diversification across both developed and emerging markets.
Instructive, if you want the lowest friction path to those global markets, you use standard domestic mutual fund platforms to invest in Indian feeder funds. You invest in local currency, there is no liberalized remittance scheme paperwork, no immediate forex conversion to calculate, and when you redeem your units, you pay standard domestic capital gains taxes. You pay a premium for that convenience. Because your local fund is simply transferring your cash to an overseas fund, you are subjected to a double expense ratio, paying both the domestic fund house and the underlying foreign manager. You also accept regulatory friction. The central bank caps the total amount of capital the mutual fund industry can remit overseas. When the industry hits that ceiling, your international SIPs can be frozen instantly. Domestic feeder funds buy you administrative peace of mind, but you pay for it through compounded fees and unpredictable bottlenecks on your monthly investments.
To bypass those domestic limits, you have to move your capital out of the country yourself, utilizing the $250,000 annual liberalized remittance scheme, or LRS. The direct route is using LRS to fund a U.S. or global brokerage account, giving you total unrestricted access to the global stock market. But direct access creates its own friction. You have to file A2 forms for every transfer, manage meticulous foreign tax reporting, and instantly lose between 1% and 2% of your capital to the bank's forex spread before you even buy a single share. There is a middle ground. Gift City is a specialized economic zone operating entirely as an outbound international jurisdiction for resident investors. You send your LRS funds directly into a SEBI-registered fund manager based in Gift City. They handle the macro allocations across Europe, Asia, and the Americas, removing the burden of picking individual foreign stocks yourself. This professional management comes with a high barrier to entry. Many of these funds require minimum upfront investments of $10,000 to $150,000, often mandating that you qualify as an accredited investor. Direct brokers and gift city routes unlock granular control and better valuations, but you must possess the upfront capital to meet the minimums and the tolerance for banking paperwork and forex fees. Warning tone. If you work for a U.S. tech company and hold RSUs, or if you actively buy individual U.S. stocks through a direct broker, you are exposed to a massive hidden liability. This chart maps the exact threshold of U.S. estate tax law for non-residents. Your U.S. domiciled assets are only protected up to $60,000. If you pass away holding more than that threshold, the U.S. government can seize up to 40% of the excess value. Your family's brokerage account is frozen, and they cannot sell the stock to pay the tax. They have to produce cash to unlock the estate. You have to structure your assets to prevent this. That means holding international brokerage accounts jointly, migrating your exposure to European domiciled index funds, known as USITS, or securing a large life insurance policy to cover the inevitable cash demand. Accumulating foreign stock without addressing the estate tax laws of the host country leaves your family locked out of their own inheritance. Route selection is directly tied to generational security. A 10 to 15% allocation to international equities is a sound baseline for most portfolios. Your execution dictates your success. If you are a beginner or lack the time to manage paperwork, follow this first path. Use Indian feeder funds, specifically opting for a broad world fund that dynamically balances U.S. and emerging markets for you. You will pay a double expense ratio, but you guarantee zero LRS friction and simplify your domestic tax filings. If you are an optimizer with $10,000 or more ready to deploy, follow the second path. Utilize gift city funds or a direct brokerage account to aggressively target emerging markets and avoid inflated U.S. tech valuations. To make this route mathematically viable, you must negotiate the forex spread with your bank manager. Every fraction of a percent you save on the transfer rate is immediate retained capital. If you hold company RSUs or ESOPs, follow the third path. Audit your U.S. holdings against the $60,000 limit immediately. Migrate future capital into U.S. OTS funds or secure the proper estate insurance to protect your dependents. Do not let short-term currency volatility stop you from acting. The rupee will jump up and down against the dollar month to month based on tariffs and central bank intervention. Global investing is not an exercise in timing the exchange rate. It is the deliberate construction of a mathematically sound, geographically diversified fortress built to protect your purchasing power for the next decade.